In this video, you will learn a complete trading strategy framework built on liquidity, order blocks, market structure, and precise entry models like the Optimal Trading Zone. Instead of relying on random setups or isolated signals, this approach is designed to help you understand how price truly moves and where real participation enters the market. By combining ICT trading strategies with smart money concepts and a structured scalping approach, you will learn how to identify high-probability opportunities, refine your entries, and execute with clarity. The goal is simple: to move from reacting to price to trading with a clear, repeatable, and disciplined framework. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Now, let us start with market structure. When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. Put simply, in classical terms, it prints higher highs and higher lows. Every time a structural level is broken, a fresh demand zone is automatically formed. This break of structure is only considered valid when a candle clearly breaks through and closes above the level. While a wick extending above the high shows that buyers managed to push price higher, it also signals an immediate rejection back into the range. This behavior often looks like a liquidity grab, where stop losses are triggered from traders who entered short after the prior rejection. If price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent high or low. As long as price holds above this area, the bullish bias remains intact and our focus stays on buy opportunities. However, if a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. But change in character takes place when price breaks and closes below this low. This indicates that buyer control is being challenged and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. When the market is in a clean downtrend and price keeps pushing lower, it respects supply zones and breaks structure to the downside. In other words, it forms lower lows and lower highs. Each time a structural level is broken to the downside, a new supply zone is automatically created. As long as price stays below this swing high, the downtrend remains valid, and our interest is strictly on selling opportunities. Here is an example. This shows the recent price action of the euro-dollar on the 1-hour chart. You can observe how price respects lower highs and repeatedly breaks structure to the downside, forming a textbook downtrend. Structure levels, swing highs and lows, and potential trade ideas are all clearly visible. If you study a chart and struggle to determine who is in control, it is often better to skip that pair. The difficulty is that markets rarely move in such a perfect way. In less ideal trending conditions, price may break below higher lows and still continue upward, misleading traders into believing the uptrend has ended. These moves frequently occur to collect liquidity or to mitigate fair value gap zones. Here is an example of how an imperfect trending market can appear. At first glance, price may look messy and directionless, but in this video, we will show you a method that turns this unclear chart into a readable and structured trend. The key idea is that in imperfect trends, your focus must stay on the overall structure instead of reacting to every small break. Many of these short-term reversals are temporary and often exist only to trigger stop losses or collect liquidity from retail traders. The first concept we will cover is how to separate major swings from minor swings. When does a swing high or swing low carry real importance, and when is it considered weak? In an uptrend, major swing lows are the critical zones where breaks of structure originate. This level represents the highest price recently reached after taking a previous high, meaning the starting point of that impulsive move defines our major low. A change of character happens when price breaks below this specific level. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. Now here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. For example, this low cannot be defined as a major swing low until price delivers a confirmed break of structure. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it. As explained earlier, only after a valid break of structure can a level be labeled as a major swing. For that reason, this level becomes the major swing low, while the remaining ones are considered minor. A break below a minor swing low still signals a loss of bullish strength. If there is a strong justification, such as a reversal liquidity sweep, coming from a higher time frame key level, you may consider a short trade targeting the major swing low. This is because once price reaches this area, supply and demand come into conflict, and we often anticipate a reaction when price taps into this major low. Still, trading against the primary trend carries higher risk, as it increases the probability of being stopped out, essentially moving against the flow of the market. Now let us review the bearish case. The ability to separate major swings from minor ones allows you to correctly define market direction and identify real reversals. After price breaks the lowest recently traded level, the starting point of that impulsive move becomes our major high. On the Euro-Dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a trend. The origin of this move is defined as the major high. As long as price stays below this level, the market remains in a downtrend. Let us continue the process of identifying major and minor swings. When price breaks through and forms a new low, we label the level where that break of structure started as the new major swing. If price only wicks with one candle below the recent low, this is not a valid break of structure and is therefore classified as a minor swing. A move above a minor swing does not signal a change in character. A real reversal only occurs when price breaks above the major high. We keep marking major and minor swing highs until a valid change of character appears, confirming a potential reversal and shifting our directional bias to bearish. In this example, we have a change of character defined by 2 clear wicks breaking above the last major swing high. However, it is important to emphasize that a change of character is only considered valid when either 2 or more wicks clearly exceed that level, or when a candle decisively closes beyond it. Then a break of structure must occur after this condition is met, confirming that the previous bearish structure has been invalidated. Another factor that strengthens the validity of a change of character is when the move is strong enough to break through the last 2 swings, not just one. If this does not happen, as in this case, the change of character is classified as a fake change of character. This was the first criterion for defining a major swing, the origin of a break of structure. There are 2 additional criteria that help us identify major swings and confirm market direction. The second criterion is the fair value gap. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure, often linked to institutional activity. The demand zone that generates this gap becomes more significant, and we expect a reaction when price revisits this area from an imbalance perspective. Demand zones that include fair value gaps are treated as major swings, while those without imbalances are considered minor. When price breaks below a major swing that created an imbalance, it signals a meaningful shift in momentum and points to a potential reversal. The same concept applies to bearish scenarios. Here we have 3 price examples. The first one shows neither a break of structure nor an imbalance, so it is classified as a minor swing. A break below this level does not signal a change in momentum or a reversal. The second example is the origin of the breakout, but does not include an imbalance. For that reason, it is considered a major swing, but only with 1 star. The third example is both the origin of the breakout and the source of an imbalance, which makes it a major swing with 2 stars. Up to this point, we have covered two criteria that define a swing point as important and major. Before moving into the third and final criterion, let us examine a trading idea. Here, we have a major swing low that initiated this break of structure. We also see another swing that created an imbalance. This level is classified as a strong swing even though it did not cause a breakout. When price revisits this level, we expect a rejection. However, if price breaks below it, that signals bearish momentum. This situation often appears when price taps into a key level from a higher time frame. At this point, we can look for short entries inside this inverse fair value gap area, targeting the major swing low, since it continues to act as strong support for price. Now let us move to the third and final criterion that helps us define a major swing, the depth of the retracement. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles, but this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum retracement is not achieved, this correction is considered invalid. As a result, this pullback does not qualify as a true swing. Instead of being treated as a completed move followed by a correction, the next push higher is considered a continuation of the same impulsive leg. In other words, both pushes are read as a single impulsive movement rather than two separate swings. This leads us to an important rule in the ComLucro framework, because once structure is clearly defined, the next step is understanding how price retraces within that structure. For a retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing. Once a valid retracement is formed, the next step is identifying where that move is likely to find real participation. Because not every level carries the same weight, and certain zones reflect clear institutional involvement that drives the next impulsive move. So once we understand how structure forms and how retracements behave, the next step is identifying where institutions are actually active. So how can we identify a valid order block on the chart? An order block represents a specific area on the chart where a large amount of capital entered the market, usually from big banks or major institutions, often referred to as smart money. Because these participants operate with significant size, their activity tends to produce strong and visible price movements. When price accelerates sharply away from a particular level, like in this example, it often signals that institutional orders were placed there. Moves of this magnitude require heavy buying or selling pressure, and the zone where those orders were executed is what we call an order block. In general, order blocks fall into two main categories. Bullish order blocks are created by aggressive buying activity, while bearish order blocks are created by strong selling pressure. Once an order block has been clearly identified, it often becomes an area of interest because price has a tendency to revisit and react from that zone. It is common to see price return to the order block and then respond with a bounce or continuation. In this example, entering at the order block would have produced a favorable move, clearly illustrating how price can react around these areas. At this point, you might be wondering whether order blocks are the same thing as support and resistance. While both concepts are used to identify important price levels, they are not identical, and there are key differences between how they function and how they are defined. The first difference lies in how each one forms. Order blocks are identified based on strong and impulsive price movement away from a specific area. When price expands aggressively from a level, that area can be marked as an order block. Support and resistance, on the other hand, require visible reactions over time. If price rejects a level once and then rejects it again later, that repeated reaction allows us to define a support or resistance level. Another important distinction is the way these levels are drawn on the chart. Order blocks are usually marked as broader zones or areas, reflecting the range where orders were executed. Support and resistance levels are most often drawn as single lines. Even when they are drawn as zones, they tend to be much thinner and more precise compared to the wider zones used for order blocks. A third difference relates to how often price can interact with these levels. Order blocks are generally considered a one-time use. Once price returns to and touches an order block, it is no longer treated as valid. Support and resistance levels, in contrast, can be tested and respected multiple times before they lose their significance. Even though order blocks and support and resistance are different concepts, they can complement each other effectively. When an order block aligns with a support or resistance level, this creates what is known as confluence. Areas of confluence tend to carry more weight, as price has a higher probability of reacting when multiple factors point to the same zone. Before we can work with valid order blocks, we first need to understand how to correctly identify them. Earlier, we mentioned that strong price movement away from an area can point to an order block. However, it is important to clarify that this alone is not enough. A significant move by itself does not automatically confirm an order block. There are specific conditions that must be met for an order block to be considered valid. With that in mind, there are 3 key rules used to define a valid order block. These rules are essential because without them, it becomes very easy to mislabel random price movements as meaningful structures. The first rule focuses on the presence of a fair value gap. For price to qualify as an order block, it must create a fair value gap immediately afterward. This gap is often referred to as inefficiency or imbalance. Whenever you hear these terms, they are simply different ways of describing a fair value gap in price delivery. To make this clearer, let us look at an example. Here we have 2 price movements that appear very similar at first glance, as both move strongly to the upside. The difference becomes clear when we look closer. The example on the left shows a gap between the upper wick of the first candle and the lower wick of the third candle. In the example on the right, no such gap exists because the wicks overlap with the candle body. This gap is what defines inefficiency or imbalance. Even though both moves are strong, only the left example qualifies as a valid order block. To mark it, we take the candle just before the inefficiency and draw a rectangle covering the entire candle, from the highest wick to the lowest wick. The second rule is that an order block must remain unmitigated. In most cases, order blocks are considered a one-time use. Once price returns and touches the order block, even if it is only a wick, that order block is no longer considered valid and should not be reused. To illustrate this, imagine you identify a gap or inefficiency on the chart and decide to mark it as an order block. If price later returns and touches that zone, even if only with a wick, the order block is considered tested. Once tested, it is no longer valid and should not be treated as a fresh order block. Although there are approaches that reuse mitigated order blocks, those will be discussed in other videos. For now, the key idea to remember is that order blocks are generally treated as a one-time use. The third rule, and the most important one, is that a valid order block must lead to either a break of structure or a change of character after it forms. To see how this works in practice, let us look at an example. In this chart, price makes a strong move upward and leaves behind a gap or inefficiency, suggesting a potential order block. However, this alone is not enough to immediately draw the order block. We must first observe whether price produces a break of structure or a change of character afterward. At this stage, we can see that price has not yet broken the previous highs, meaning a break of structure has not occurred. Because of that, we wait and allow price to continue developing. Once price eventually breaks this high and creates a break of structure, that is the moment when we can draw the order block on the candle just before the inefficiency. In the next example, price again moves aggressively upward, creates inefficiency, and then follows through by breaking previous highs. Since this sequence results in a clear break of structure, it confirms another valid order block that can be drawn. With that in mind, order blocks help us understand where strong institutional activity has taken place, but their real value comes from how they align with structure, swings, and valid retracements. When these elements work together, the market becomes significantly more predictable. Now take a look at these examples. In the first case, none of the criteria we covered are present, so this level is classified as a minor swing. In the second case, we have a break of structure and a valid retracement, but no imbalance. For that reason, it is labeled as a major swing with 2 out of 3 criteria met. It is important to note that the retracement reaches at least the 38.2% level, which makes the swing valid. In the next example, we see an imbalance and a valid retracement to 38.2% or more, but there is no valid break of structure, so this is also considered a major swing with 2 stars. In the final example, the swing has created an imbalance, broken structure, and shown a proper retracement. This makes it a major swing with 3 stars. Breaking below this low confirms a valid change of character, signaling a true shift in market direction and momentum, or however you prefer to define it. Up to this point, we have shown how to identify major swings and valid changes of character, and why not every break signals a real reversal. Liquidity sweeps and fair value gap mitigation can invalidate a change of character. When a major swing sits in a liquidity area, a break may only be a stop hunt, with smart money sweeping liquidity before continuing the trend. The same applies to fair value gaps. Price often breaks structure only to rebalance an imbalance, not to reverse. Now that you understand how market structure works, how swings are formed, and where institutional activity takes place, the next step is refining how you approach retracements, because identifying the trend is only part of the process. You also need to understand where a correction is most likely to end, and where the next impulsive move is most likely to begin. So, what is ICT's Optimal Trading Zone and Optimal Trade Entry? This is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. Its goal is to identify where a pullback is most likely to end, allowing traders to enter with precision instead of chasing price or reacting late. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range, the optimal trading zone, located between the 61.8% and 78.6% levels, highlights areas where institutional participation is likely to return in the direction of the dominant trend. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear, repeatable framework for high-probability trade entries. Now, let us apply this directly to price and break down how these retracements develop step by step. As we begin our chart analysis, the first step is identifying the main price swings and key structure levels. In other words, using a top-down approach from higher time frames to lower ones allows us to build a complete understanding of market conditions across all levels. When we refer to higher time frame key levels, we're looking at the weekly, daily, and 4-hour charts. Any time frame below 4 hours is considered too short-term for large institutions to properly execute and refine their strategies. When we observe price reacting from a higher time frame resistance level, it is reasonable to assume that institutional participants showed interest in selling at that area. On the other hand, if price moves higher from a support level, it indicates that institutions were likely interested in buying at that point. This approach keeps our focus away from minor intraday price noise. Instead, we concentrate on meaningful moves that suggest strong participation from major market players. These broader trends appear clearly on higher time frames, which we have consistently highlighted as essential for proper analysis. As a result, identifying higher time frame swings and key levels allows us to see the market from a wider perspective and avoid positioning ourselves against dominant flows. From there, we can shift our attention to lower time frames, such as the 1-hour and 30-minute charts, to identify potential trading opportunities. Here is the improved rewrite, keeping the same structure, flow of ideas, and timing, while making the language smoother and more natural for narration. When observing the chart, you will notice that the market consistently moves through impulsive and corrective waves. This fractal behavior exists because of how market participants interact with price. Impulsive waves tend to drive price a greater distance with strong momentum, usually shown by same-colored candles with large bodies. In contrast, corrective phases reflect indecision, appearing as mixed color candles with smaller bodies and sideways wicks. Being able to identify the end of a pullback and the beginning of the next impulsive move can be extremely profitable, as it allows traders to position themselves early in potential buying or selling opportunities. Now imagine we're in an uptrend and want to buy low and sell high to take advantage of this bullish market. We cannot enter a buy position immediately because price is already extended and may correct at any moment. That is why we wait for a pullback to enter at a more favorable price. The most recent impulsive move started from this point and pushed price higher all the way to this level. The correction will take place within this range, and once enough liquidity is collected and buyers step back in, price is likely to continue pushing higher. If price breaks below this level, it suggests that buyers are no longer in control and the entire uptrend narrative comes into question. This signals strong bearish momentum and a potential reversal, unless the move turns out to be a fake-out designed to collect liquidity below the low before price resumes higher. Now, let us return to the correction range and connect this directly with execution. This brings us to an important question. Where should we place our long position and enter the market? If we enter too early, price may continue pulling back deeper, and we could be stopped out even if our overall analysis remains correct. On the other hand, if we wait too long, price may already start moving higher, and we miss the opportunity entirely. So the key to trading in the direction of the dominant trend is identifying the end of the correction, which signals the beginning of the next impulsive move. But how do we identify that moment? This is where Fibonacci retracement levels become essential. We always draw this tool from the start of the impulsive move to its end because it helps define the correction range. Once applied, you will notice several levels appear on the chart. Each of these levels can act as support and potentially cause price to react or reject when reached. However, two specific retracement levels form what ICT defines as the Optimal Trading Zone, or OTZ. These are the 61.8% and the 78.6% levels. There are several reasons why this zone is considered an ideal area for trade entries. Reason number one is a better risk-to-reward ratio. Regardless of where we enter, the first logical target for the trade is the most recent market structure level. When price reaches this level, some traders will take profits or close positions, while others may enter new trades. This behavior can cause a pause, a pullback, or even a reversal. That is why this level serves as our first target. When entering inside the OTZ, the risk to reward becomes more favorable. We always aim for trades with at least a 1 to 2 risk to reward ratio. This is why trading within the optimal trading zone provides a higher risk to reward and results in a more structured and rational trade. Reason number two is a safer entry. The market often looks to remove early buyers and use their positions as liquidity for future moves. That is why waiting for price to reach the optimal trading zone and then searching for long signals can significantly improve our win rate. Of course, every strategy has its drawbacks. With a more conservative approach, we may miss some trades, but missing a trade is always better than taking a loss. Reason number three is a safer stop. The most logical and secure area to place our stop loss is below the most recent swing low. If price breaks below this level, it signals a market structure shift. In that scenario, buyers lose control, and the bullish case becomes invalid. Because of this, bulls will strongly defend this level. As a result, the closer our stop is placed to this swing low, the safer the trade becomes. This is the third reason why entries inside the OTZ are preferred. With all of this in mind, identifying a valid entry trigger within this zone becomes a natural extension of everything we have covered so far, from structure to retracement and institutional activity. This trigger can come from different price action signals, which we will explain next. This trading model is built around three simple steps: analysis, execution, and trade management. Let us begin with the analysis phase. As mentioned earlier, this is a trend continuation setup, where our goal is to anticipate the end of the pullback or correction and align ourselves with the dominant trend before the next impulsive move begins. In the first step, our goal is to define the market direction and identify the most recent impulsive wave. We only apply this setup when the direction is clearly established. To be considered valid, the latest impulsive move must break the previous market structure. At this point, there is one final condition to check. We must confirm that there is sufficient room for price to move before reaching a higher time frame key level. If price has already mitigated a major supply zone on the higher time frame, we will not enter a buy trade without additional confirmation, because that level has enough influence to potentially reverse the prevailing uptrend. So during the analysis phase, we focus on three things: market direction, the latest impulsive wave, and the available room before price interacts with a higher time frame key level. The next step is trade execution. Here we wait for price to pull back and then apply the Fibonacci retracement tool from the beginning of the impulsive move to its end. We place a buy limit exactly at the midpoint between the 61.8% and 78.6% levels, which is the 70.5% retracement. Our stop loss is placed a few pips below the swing low. The final step is trade management and target selection. We know that when price reaches this higher time frame area, it is likely to act as resistance and push price lower. Because of that, our first target is set just before this level, often near the close of the highest candle. The same logic applies when trading a bearish scenario. So as you can see, this model relies entirely on basic price swings and retracement levels. At this point, some of you may think that trading cannot be this simple and still remain profitable. However, simplicity plays a crucial role in Forex trading. Your trading plan must be clear and straightforward, with mechanical rules that precisely define where your entry, stop loss, and targets are placed. By trading this way, you can rely on your backtesting results with confidence, knowing that emotions are removed from your decision-making process and that your tested results closely reflect real market conditions. Now, this was the core version of the model. We have expanded it further by combining it with multiple smart money concepts, including fair value gaps, market structure shifts, and multi-time frame entries, which we will explain next. We begin with the first type of entry by combining the optimal trade entry model with fair value gaps. Here we have a well-defined uptrend. Our objective is to wait for a pullback and enter a long position at a more favorable price. If price breaks below this level, the entire bullish scenario comes into question, as it signals strong bearish momentum. This defines our correction range, and by applying the retracement tool, we can clearly identify the optimal trading zone. Now, if we look to the left side of the chart, we can see that the most recent impulsive move has formed several fair value gap areas, one of which aligns directly with the optimal trading zone. When price retraces into these zones, they can act as support and potentially drive price higher. A more conservative approach, however, is to wait for price to retrace deeper into the third fair value gap and enter the long position there. This is because price may use the first fair value gap as a liquidity grab, trapping early long positions. In summary, combining the optimal trading zone with fair value gap areas creates strong supply and demand zones and offers a high-quality trading opportunity. So, we move on to the second type of entry by combining the optimal trade entry model with market structure shifts. Here, we had a long-term downtrend until price failed to form a new lower low, signaling a loss of bearish momentum. Shortly after, price broke through the supply level to the upside. This change of character indicates that sellers are no longer in control and suggests a potential bullish reversal. Once price breaks structure above the previous high, it confirms that buyers have taken full control, marking a complete market structure shift from a downtrend into an uptrend. At this point, we can begin looking for long opportunities to benefit from the emerging bull market. This leads to an important question. When should we enter a long position? Even though price has a strong probability of continuing higher, entering at a poor level could still result in a stop-out. This is where price swings and ICT's optimal trade entry come into play. Our directional bias is bullish, and there is sufficient room for price to move before reaching the next significant higher time frame level, located above. We can now apply the retracement tool to the most recent impulsive move and place a buy limit at the 70.5% retracement level. Our stop loss is set a few pips below the swing low, and our targets are defined according to the trading plan. This is how we combine optimal trade entry with market structure shift concepts to execute a high-quality trade. However, it is crucial to remember that no matter how strong a setup may appear, the market can always behave differently. Risking an excessive amount on a single trade simply because the probability seems high is a poor decision. Trading involves anticipating future price movement, and the future is inherently uncertain. After a 50% loss, a trader must gain 100% on the remaining capital just to break even. In Forex trading, survival always matters more than short-term gains. Now we move on to the third type of entry, using a two-time frame entry approach. In this trading setup, we use two different time frames to execute the trade. Most of our analysis is done on a higher time frame, such as the 1-hour chart. And then we zoom into a lower time frame, like the 15-minute or 5-minute chart, to find confirmation and execute the entry. Let me walk you through the process. On the 30-minute chart, we can clearly identify an uptrend. We apply the retracement tool and define the optimal trading zone. As discussed earlier, once price pulls back into the optimal trading zone, we shift our focus to a lower time frame to look for an entry trigger and execute the long position. However, on the lower time frame, this same pullback may appear as a short-term downtrend. Our objective, then, is to identify signals that show this lower time frame downtrend is coming to an end, allowing us to enter a long trade in alignment with the dominant bullish direction of the higher time frame. When we observe a clear change of character, it provides a valid signal to consider a long entry. In this example, we know the higher time frame trend remains bullish and price is trading within the optimal demand area. As a result, we have combined multiple price action concepts and confirmations to justify this trade. Combining optimal trade entry with additional price action techniques such as fair value gaps, liquidity concepts, chart patterns, candlestick structures, or any other entry confirmations you use can create a robust and well-structured trading strategy. Now that you understand how to build a structured entry using the optimal trading zone and multiple confirmations, the next step is applying this framework in real market conditions. Because identifying the entry zone is only part of the process. What truly matters is how that idea is executed on lower time frames. When this framework is applied correctly, it becomes clear why many scalping strategies fail. Not every break is a reversal, not every wick matters, and not every move against the trend signals a shift in control. With this clarity, scalping becomes structured instead of reactive. In the next section, we will apply these concepts directly to execution. You will see how breaks of structure, changes of character, liquidity grabs, and fair value gaps work together to form high probability entries on lower time frames. Before we begin, it's important to note that scalping strategies focus on short-term trades within lower time frames, especially during periods of high market liquidity. Because scalpers operate on these smaller time frames, They face more false signals and must manage risk with precision. It's also best to focus on major pairs with tighter spreads, since every pip counts when targeting moves of just 10 to 20 pips. Most trades are completed within an hour, making scalping perfect for traders who want quick results without spending too much time on the charts. So, here's a quick checklist every scalper should review before analyzing the market and placing trades. Now, let's move on to the first scalping strategy. In this setup, we use two time frames, the 30-minute and the 5-minute charts. On the higher time frame, we analyze the market structure to identify the overall direction. We look for breaks of structure, BOS, and changes of character, CHO, to confirm the trend. Then, we manually mark the fair value gaps, the zones that highlight the best areas to look for potential trades. Once price returns to those gaps, we switch to the lower time frame. On the 5-minute chart, we wait for a clear entry signal, typically when a liquidity grab pattern appears. After spotting that setup, we enter the trade and define our targets. This approach works because it combines three key elements: trading in line with the trend, taking entries from strong supply and demand zones, and using lower time frame confirmation for precision. Now, let me show you how this works directly on the price chart. In the first step, we identify the market direction by marking breakouts and changes of character, or BOS and CHO. These can easily be drawn manually using simple trend lines and labels to visualize structure shifts on the chart. Start by marking each break of structure that confirms trend continuation and each change of character that signals a possible reversal. These two elements form the foundation of market structure analysis. In this example, we can see the price breaking structures to the upside on the 30-minute chart. That means we're in an uptrend and should focus only on buying opportunities. Next, let's talk about fair value gaps. These are imbalances on the chart, zones where price moved so quickly that it left a gap between candles, creating an area of inefficiency. The market often returns to fill these gaps as it seeks balance. We'll use these manually marked gaps as key zones of interest, expecting possible price reactions when price revisits them. First, wait for the price to trade back into the gap, then move to the lower time frame to look for confirmation signals before entering a buy position. So, let's switch to the 5-minute chart. On this lower time frame, the goal is to spot signs of a possible reversal. One strong clue is a bullish liquidity grab, when price briefly wicks below a previous swing low before reversing upward. This move shows where stop losses were triggered, followed by a sharp reaction in the opposite direction. Liquidity grabs often occur near key zones like fair value gaps and can serve as powerful entry confirmations. When this move also breaks a recent bearish structure on the lower time frame, it gives us extra confirmation. In other words, it forms a change of character. Now it's time to execute the trade. Place your stop loss just below the low of the liquidity grab and set your target at the next key level identified on the higher time frame. In a bearish setup, start on the higher time frame by confirming a clear downtrend marked by lower lows and lower highs. Then, manually outline the fair value gaps as potential supply zones. When price retraces into one of these areas, move to the lower time frame and look for a bearish liquidity grab just above a recent swing high. Enter the trade once confirmation appears. Set your stop loss above the liquidity grab and aim for the next major support level below. Finally, always apply solid risk management to protect your capital. Stick to your plan and stay disciplined, avoiding emotional decisions. This strategy performs best in trending conditions, not in sideways or choppy markets. Keep learning and reviewing your trades to keep improving over time. Let's move on to the second scalping strategy. This setup has three main parts: a draw on liquidity, a liquidity grab, and the entry. So, what is a draw on liquidity? It simply means identifying a key liquidity level that price is moving toward. In other words, the market often moves toward areas with resting liquidity, such as equal highs, equal lows, or sharp reversal points, because that's where many orders are waiting to be filled. You can mark these levels manually by drawing lines across equal highs and equal lows, or by highlighting clear buy-side and sell-side liquidity zones on your chart. With that in mind, the first step is to locate a major high or low on the 30-minute chart that price is approaching. In this example, we have buy-side liquidity on the 30-minute chart, and price is being drawn upward toward it. We can anticipate that move, since liquidity tends to attract price. If a clear draw on liquidity isn't visible on the 30-minute chart, zoom into the 15-minute chart for more detail. Next, we look for a liquidity grab in the opposite direction of our draw on liquidity, this time on the 5-minute chart. So let's switch to the lower time frame. Keep in mind that in this case, the buy-side liquidity sits above us. At this point, we're looking for a swing low to be taken out, a sign that price may continue moving upward. You can enter the trade as soon as price returns inside that range. Alternatively, a more conservative approach is to wait for confirmation. Let price push higher to confirm the reversal. Then identify a manually marked fair value gap to set a buy limit. If no clear gap appears on the 5-minute chart, zoom into the 1-minute chart for greater precision. Let's quickly recap the bearish setup. In a bearish scenario, start by identifying a major liquidity area that price is moving toward, such as a previous low or a level packed with stop losses. These zones often attract price before a reversal occurs. Then, switch to the 5-minute chart and watch for price to move above a recent swing high before snapping back down. This action shows a liquidity grab, suggesting the market may start trending lower. Next, open a short position and place your stop loss above the high of the liquidity grab. Allow price enough room to move. Avoid keeping your stop too tight. For your target, aim for the next clear sell-side liquidity level. This keeps your trade structured and intentional. Now let's move on to the final scalping strategy, one that's completely based on pure price action. This method uses just a single time frame, and you can choose whichever best fits your trading style. First, identify the market direction to decide whether you're looking to buy or sell. Trading in the same direction as the dominant trend increases both confidence and consistency. What we want to see here is a clear trending environment. In an uptrend, price should form higher highs and higher lows while respecting the previous swing lows. In a downtrend, it should create lower lows and lower highs while respecting the swing highs. In the case of an uptrend, wait for price to form equal highs and then break above them. From basic price action principles, we know that when price revisits this breakout zone, previous supply turns into demand, meaning there's a stronger chance for price to bounce back upward. So we wait for a pullback into that zone and then look for confirmation before entering a trade. You can enter once a candle closes above the previous candle's high. That's your signal that the level is being respected. If there's no confirmation and price keeps falling, simply skip the setup. You can also zoom into a lower time frame to refine your entry. After price returns to your demand zone, switch to the lower time frame. You'll often notice a short-term bearish correction, which represents the pullback from the higher time frame. Draw a trend line across the wicks with the most touches and wait for price to break above it. Once that breakout occurs, you can open a long position. Place your stop loss below the swing low and set your first target at the swing high. This confirms that the short-term downtrend has ended and price is ready to continue upward, following the main bullish trend. Now let's look at the bearish version of this setup. In this case, the higher time frame shows a clear downtrend, with price consistently forming lower lows and lower highs. What we're looking for is an equal low followed by a clean breakout to the downside. When price pulls back to this breakout area, the previous demand zone now acts as supply, meaning there's a stronger chance that price will reject this level. For confirmation, wait for a candle to close below the previous candle's low. That's your signal that sellers remain in control and it's time to consider a short position. If that confirmation doesn't appear and price keeps rising, simply skip the trade and wait for the next setup. For a more precise entry, Zoom into the 5-minute chart. You should see a small bullish correction, a short-term uptrend against the main downtrend. Draw a trend line across the lows of this move and wait for a break below it. Once it breaks, you can enter a short position, place your stop loss above the recent swing high, and set your first target at the previous swing low. This setup shows that the short-term pullback has ended and the price is ready to continue downward with the overall bearish trend. Keep in mind that you can always check the higher time frame to see where the price is positioned in the bigger picture and whether your analysis aligns with it. For example, if there's a key market structure level right in front of the price, there's a higher chance that the setup will fail. That's because when the price reaches this level, it's likely to get rejected by the market. So always check the higher time frame to make sure there's enough room for price to move in your direction before reaching the next key level. That simple habit keeps you aligned with the broader market flow and helps you avoid trades that run straight into major structure. If this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.